The average millennial has scrolled past roughly 47 different get-rich strategies this month alone and still has less than $10,000 invested, not because they're lazy, because nobody ever gave them the actual sequence. I have spent years studying how ordinary people build real, lasting wealth, not the lucky ones, not the ones who inherited family money, but regular people with regular salaries who figured out the system early enough to let it work for them. And today, that is exactly what I am going to hand you. If this is your first time here at Sara Builds Wealth, hit subscribe before we begin, because laying out exactly this kind of clear, no-nonsense sequence is what this channel does every week. Here is what you're going to get by the time this video is done. A literal step-by-step blueprint, the exact sequence I would follow if I were starting from zero today in 2026, which accounts to open first, what to actually buy inside them, how much to invest, and the one psychological shift that separates people who build wealth from people who spend their whole lives almost getting there. Stick around for that last part specifically because I saved the most important insight for the end, and it is not what you think it is. Step 1. Understand why you are even doing this. Before you open a single account or transfer a single dollar, you need to deeply understand why investing is not optional. Here is the thing most people miss. Your money is not safe just because it is sitting in a bank account. Inflation in the United States currently runs around 2.4% annually. That means your $50,000 savings cushion is silently losing over $1,000 of purchasing power every single year. You did not spend it, nobody stole it. But in 30 years at that rate, that same $50,000 will buy you roughly what $27,000 buys today. You lose almost half your wealth to inflation without making a single bad decision. Meanwhile, the stock market has historically returned around 10% annually before inflation, about 7% after. Put that same money to work consistently over 3 decades, and you are not talking about survival money, you are talking about a genuinely life-changing number. That difference is why we invest. Staying on the sidelines is not playing it safe. It is a guaranteed slow bleed. Step 2, get your foundation right before you touch anything else. I know you want to jump straight into investing apps and portfolio strategies. But if you do not have 3 to 6 months of living expenses in a high-yield savings account first, you're building on sand. Here is why this matters so much. Markets drop, sometimes 20%, sometimes 50%. That is not a worst-case scenario, that is just market history. If you invest everything and then your car breaks down or you lose your job, you are forced to sell your investments at exactly the wrong moment, locking in losses permanently. Your emergency fund is the firewall between your financial life and your investment account. Build it first. Park it somewhere earning actual interest. Then and only then are you ready to invest without flinching every time the market sneezes. Step 3. Attack your tax-advantaged accounts in the right order. This is where most people either leave serious money on the table or get the sequence completely backwards. Here is exactly how I would do it. First, and this is non-negotiable, if your employer offers a 401k with a company match, contribute at least enough to capture the full match before you do anything else. A typical match gives you 50 cents for every dollar you contribute up to around 6% of your salary. That is an instant 50% return. Nothing in the investing world beats that, nothing. Leaving that match on the table is the equivalent of turning down a raise every single paycheck. After you capture that free money, move to a Roth IRA. For 2026, you can contribute up to $7,500 if you are under 50. With a Roth, you contribute money you have already paid taxes on, your investments grow completely tax-free, and when you pull that money out in retirement, you owe the government absolutely nothing. Zero. When you are in your 20s or 30s and probably not in your peak earning years yet, paying taxes now and locking in decades of tax-free growth is an extraordinary deal. If you qualify based on income limits, single filers start phasing out at $153,000, max this account every single year. If you have a high-deductible health insurance plan, there is one more account that most people completely overlook. The Health Savings Account, or HSA. For 2026, you can contribute up to $4,400 for individual coverage. What makes the HSA the secret weapon in this whole system is what is called the triple tax advantage. Your contributions are tax-deductible, your growth is tax-free, and when you withdraw for qualified medical expenses, that is tax-free too. No other account in existence gives you all three. If you can afford to pay your current healthcare costs out of pocket and let the HSA compound untouched for decades, you have essentially created a second retirement account with better tax treatment than either a traditional or Roth IRA. That is not a minor detail, that is a life-changing arbitrage most people never discover. Step 4, know what to actually buy inside those accounts. Okay, you have got the accounts open. Now what do you put in them? This is where most beginners either get paralyzed or get seduced by the wrong thing. Individual stock picking sounds exciting. It makes for great dinner table stories. But here is the brutal truth. The majority of professionally managed funds, run by analysts with Bloomberg terminals and decades of experience, fail to beat a simple index fund over a 10-year period. If the pros cannot consistently do it, the odds are not in your favor doing it in your spare time on your phone. Instead, what you want is a low-cost index fund that simply owns everything. A single S&P 500 ETF, something like VOO from Vanguard or IVV from iShares, charges as little as 0.3% annually and instantly gives you ownership in 500 of the largest companies in America. If you want broader coverage, VTI owns essentially every publicly traded company in the United States, roughly 3,600 stocks for the same rock-bottom fee. One purchase, instant diversification. No stock picking required. Here is what those fees actually mean in practice. Investing $500 a month for 30 years at 10% returns with a 1% expense ratio gets you to about $900,000. The exact same investment with a 0.3% fee gets you to approximately $1.1 million. That tiny difference in fees is worth over $200,000 out of your pocket over a lifetime. Pick the low-cost fund. It is that simple. Still with me? Good, because this next part is where most people completely fall apart, even the ones who did everything right up to this point. Step 5. Automate everything and then get out of your own way. Most people think the hard part of investing is figuring out what to buy. It is not. The hard part is not selling when everything feels like it is collapsing. In 2022, the market dropped roughly 19%. Portfolios that were worth $100,000 at the start of the year looked like $81,000 by December. People panicked. They sold. They locked in those losses permanently. In 2008 and 2009, the market fell over 50% from peak to trough. Investors who buy late at the bottom missed the subsequent bull run that pushed that same index up over 500%. Every major crash in stock market history has eventually recovered and reached new highs. Every single one. Knowing that intellectually is one thing, watching your net worth cut in half on screen is something completely different. The solution is automation. Set up an automatic transfer from your checking account to your investment account on the same day every month. Set your chosen index fund to purchase automatically, then stop looking. Check your account quarterly at the absolute most. The more often you look at your portfolio, the more emotionally reactive you become, and emotional investors consistently underperform boring, automated, do-nothing investors. The best move you will ever make is making it impossible to panic sell by forgetting the account exists. And now, the piece I saved for last, the one that actually determines everything. Here is the insight that does not get talked about enough. The number you invest every month matters far less than you think relative to when you start. Let me give you a real example. Someone who invests $200 a month starting at 25 and earns 10% annually will have approximately $450,000 by 65. Someone who waits until 35 and invests $400 a month, double the monthly amount, ends up with roughly $450,000 too. Double the monthly contribution for 30 years versus 20 years gets you to the same place. Those 10 years you waited cannot be bought back at any price. The market does not care how hard you hustle later to make up for starting late. It only cares about time. This is not an argument to invest a tiny amount and coast. Grow your contributions aggressively every time you get a raise or pay off a debt. But the most powerful move you can make right now today is simply starting, not optimizing, not perfecting your allocation, not waiting for the market to dip or the headlines to calm down, starting. A $50 automated investment you set up tonight is worth more to your future wealth than a $500 investment you spend the next 3 months getting ready to make. Here is your one action. Open a brokerage account at Fidelity, Schwab, or Vanguard today. Set up an automatic monthly transfer for whatever you can genuinely afford right now. Buy a low-cost index fund. Walk away. That is it. That is the whole game. Now I want to hear from you. Which of these steps have you already started, and which one have you been putting off the longest? Drop it in the comments below. I read every single one, and I want to know exactly where you are in this journey so I can create videos that actually meet you there. And if this video gave you something real and concrete, not just motivation, but an actual plan you can execute this week, that is exactly why subscribing to Sara Builds Wealth makes sense, because that is what this channel is built on. No fluff, no vague advice, just the specific, honest information you need to actually move the needle on your finances. The gap between knowing and doing is exactly where most people's financial futures go to die. You just close that gap, now go do the thing.